I had a client come to me last year. It was their second year running an e-commerce store and it was absolutely taking off. They were on track to make about 400 grand. Here's the problem. They were still operating as a sole trader. So they were about to pay 165,000 in tax on that 400,000. Now, if they'd gotten some advice earlier and just structured their business properly, they could have paid about 100 grand instead. That's a $65,000 saving just by getting the foundation right. I'm Byrne from Day One Advisory. We work specifically with e-commerce businesses, helping them get their financials sorted and helping them pay less tax legally. And if you're doing 500K plus in revenue, what I'm about to share could literally save you tens of thousands in tax. We're going to cover 5 specific strategies that, when implemented correctly, will guarantee you pay less tax than what you're paying right now. All right, let's start with the foundation. And this is where that client I mentioned went wrong. For most businesses, it's pretty standard to start as a sole trader. It's free to set up, you just get an ABN online and you're off and running. If you're testing the waters or it's more of a side hustle, that makes perfect sense. But e-commerce is a little bit different. If your intention is that you're going to become your full-time gig and you're planning to make serious profit from it, then starting as a sole trader is actually setting yourself up to overpay tax from day one. For e-commerce businesses, the standard approach should be a company as the operating entity with shares held by a trust. Now, I know that sounds complex, but here's why it matters. Firstly, e-commerce businesses have the potential to make some serious money. You want access to that 25% tax rate, not the personal marginal tax rates that can hit 47%. Second, you use a lot of working capital. Unlike a service-based business where profits can flow out to the owners, your profits are usually reinvested back into the stock. You want that money retained in the company structure where it's taxed at 25%, not flowing out to you personally where it might be taxed at 47%. And third, every time you change structure, you create a potential capital gains tax event. The time to get this right is before you've created value in the business, not after. So let's say you start as a sole trader and your business grows to be worth 500 grand. If you want to transfer that to a company structure, you're potentially looking at a capital gains tax bill on that 500 grand of value you've created. There are some rollover concessions that let you defer that gain, but here's the catch. To get those concessions, you usually have to own the company shares personally. That means you can't put the trust structure in place without triggering the capital gains tax. So you end up stuck. You can avoid the immediate tax bill by owning the shares directly, but then you miss out on all the tax planning flexibility that comes with having a trust as the shareholder. The time to get this right is before you've created value in the business, not after. When your business is worth zero, there's no capital gain to worry about. But once you've built something valuable, restructuring becomes expensive and complicated. The second way to reduce your tax bill is to get your inventory accounting right. Good inventory accounting directly affects both your tax outcomes and your day-to-day business health. Get it wrong, and you're either overpaying tax or you're setting yourself up for potentially some ATO penalties. Here's how it works. The ATO requires you to calculate your cost of goods sold correctly to work out your taxable profit. You can only claim a tax deduction for inventory when you've actually sold that stock, not when you purchase it. At year end, you must account for the value of your closing stock. If your inventory has grown, this reduces your allowable deductions. If it's fallen, it increases your deductions. Get this calculation wrong and your tax bill will be wrong too. Now here's where you can create immediate tax savings, write-offs and shrinkage. So damaged, expired or obsolete stock can usually be written off for tax purposes, but only if you have documented inventory records showing these adjustments. I had a client who had 15 grand worth of obsolete stock they'd mentally written off, but never properly documented. Once we cleaned up their inventory accounting, that became a legitimate $3,750 tax deduction that they were missing. The good news is that most e-commerce systems can automate a lot of this inventory accounting. Setting this up properly means fewer manual errors, cleaner tax reporting, and you're audit ready if necessary. The third way you can reduce your tax bill is if you're shipping products overseas, basically you can eliminate GST on those sales while still claiming back the GST on your purchases. This can improve your cash flow significantly and reduce your overall tax burden. When you sell to overseas customers and you ship the products out within the required timeframes, you don't charge Australian GST on that sale, but you can still claim all the GST back on your advertising, your product purchases, shipping costs, and everything else. This is also why the company structure makes even more sense for e-commerce. When you're dealing with international tax authorities, they understand companies. It keeps everything clean and maximizes your deduction opportunities. The fourth way to reduce your tax bill is strategic timing. If you've got expenses coming up in in July or August, like equipment purchases, maybe advertising spend, or some consulting fees, for example, bringing them forward into 30 June gets you the deduction this financial year instead of next. So let's say you're planning a $30,000 warehouse equipment upgrade. If you can bring that forward by a few weeks, you could potentially save $7,500 in tax this year at the 25% company tax rate. This works for software subscriptions, maybe marketing campaigns, professional fees, equipment purchases under the threshold, anything you're going to spend anyway. The key is planning ahead so that you can time these expenses strategically. But remember, inventory is only deductible when sold. So buying a bunch of stock before 30 June will just tie up cash without any tax benefit. The fifth strategy is for those thinking a bit longer term. If you're planning on selling your e-commerce business down the track, there's potential to make that sale completely tax-free using the small business CGT concessions. We're talking about eliminating potentially hundreds of thousands in capital gains tax. But there are strict eligibility criteria you have to meet. I had one client who would have paid about 300 grand in capital gains tax on their sale. The issue was that they had these Div 7A loans on their books, essentially money they'd taken away from the company over the years without properly documenting it as wages or dividends. These loans made them ineligible for the concessions because the ATO sees them as a sign that the business assets are being used for personal benefit, which breaks one of the key eligibility rules. We spent 3 years cleaning up the structure for this business. This meant converting those loans to proper dividends, paying the associated tax, and then running the business cleanly for the required period to prove eligibility. Eventually, that saved them 300 grand in capital gains tax. Now, separate from these 5 strategies to reduce your tax liability, there are also ways for you to optimize your current tax position while you're building the business. Using holding companies and bucket companies, for example, you can park excess profits at the 30% company tax rate while keeping them away from the operational business risk. So instead of leaving 200 grand cash sitting in your trading company where it's exposed to business liabilities and to risk, you can distribute it to a holding company as a dividend. It stays in the 30% tax environment, but it's protected if something goes wrong with the main business. And with the right trust structure in place, you can split distributions between family members in maybe lower tax brackets. So instead of you paying 47% tax on the distributions, you might distribute some to a spouse in a lower tax bracket that's got maybe a 30% tax rate, or potentially even adult children that pay 16%. Now, I need to be super clear, optimizing your tax structure is highly personal and it depends on your specific circumstances, your family situation, and ultimately your business goals. You absolutely need to get proper advice before implementing any of these strategies. But these are some of the things that you can start thinking about and discussing with your accountant. What I can tell you is this: the longer you wait to get proper advice and implement the right strategies, the more expensive it becomes to fix later. Some of these opportunities, like the structure optimization, have a window that closes once your business reaches a certain value. If you're doing 500K plus and you want to understand exactly what opportunities exist for your specific situation, we do comprehensive tax reviews where we look at your business, your structure, understand your goals, and calculate your potential tax saving. There's a link in the description to book a call with our team. Otherwise, see you in the next video.